for joining, guys. Let's get rolling here. I think we're gonna kind of reverse it today here, and I'm gonna show you guys here. We'll start with the commodities today. I feel like the big news is the 6,500 for S&P and the Nasdaq, relentless, right? That's the right word for it. But I kind of feel like, so in general, the theme here is more about like when equities do roll over, I feel like that's when commodities are going to like kind of catch a bid here. I feel like we're already seeing it with natural gas. And so like oil kind of screwed up that one today, where now it looks like an ABC up, but I kind of feel like we might see just a bit low over low here to touch on a fib level and then head back up here for oil. So just to kind of put it in context, I do kind of think that, if like some of this economic, and you'll have to excuse me, by the way, I kind of have like a sore throat going on. But aside from all these fibs and everything, if we do see this like C leg up here, if some of the data and stuff starts to show, weakness in general, I think probably what we'll see is like a lower leg down here. And as much as I don't expect it to happen like all at once, of course, what I do expect though is, again, if equities head back down, and also like we get some bad econ data, we should see some sort of like some sort of retrace here lower with gas, or sorry, not gas, with oil, just with like less gasoline demand, people staying at home, laid off, that kind of thing. I mean, we typically see that with recessions, but we haven't really declared it a recession, but some of the data is looking kind of weird. You get I'm seeing a lot of articles about people not being able to find jobs and just asking around, chit chatting with people at the local watering hole. Just kind of seems like there's a general malaise out there about just wage growth, static like inflation and just expectations of what's going on here. So again, I think like with commodities though, everybody needs to eat, everybody needs to drive around. There's going to be demand for that, but with reduced demand with like oil and gas, gas you can't really do much without in the wintertime. So that's kind of why I was thinking, I think it was, what was it? Oh, Monday. Yeah, so Monday, Tuesday, I'm kind of like, oh, let's give it a day, wait and see if it bottoms, and that's when I added that last unit of oil. But that seemed to be a good place to bounce. I still think that it's possible we might see like a 5 waver down, but now that we're in September, I don't know. I mean, like for example, I could probably, sorry, that's actually supposed to say bull target. I might take some profits up here, or maybe like take half or something and let the other half ride. What I haven't been doing a lot lately is letting like some of the position ride, like so lighten it up. So I was kind of like take my own advice. It's not advice, take my own recommendation, with just leaving a runner, that kind of thing. Because sometimes you can be surprised to the upside with the gas and oil and those kinds of things. But
there was one tidbit of news out that Ukraine has been bombing the Russian refineries.
Yeah. So and they also I'll have to read up it a little bit, but I thought when they seized that gas pipeline by Kursk, that it would have an issue, or that would create some sort of problems for those guys, but it didn't really materialize very much. I mean, like a little bit, but nothing that really kind of broke the mold with a lot of the seasonality. Really, when we saw that the break of the mold with seasonality was late last year, where wasn't able to get out of that oil trade for forever. So now things have changed a little bit here. Now I think that we're getting close to that super excess. Whereas late last year we were just in excess. So, and I'll talk a little bit about that now that the S&P's hit the 6,500, about like some of the option structure behind that. But anyways, like so, I guess the long story short here with excuse me again. The long story short here is that I feel like commodities are going to get kind of that tailwind if equities start to sell off here in a decent way, where you might get that retracement back up here, like with gas, with oil, just because like people they don't really have a good place to put their money if equities start to turn. You don't really want to buy bonds because the risk premium isn't really the best there. Plus, you can have like carry trade blow up stuff. So I think people are getting a little skittish about bonds. And then crypto also is still pretty speculative. Like we've had, even though it's gone, gained general acceptance here, we still have this. Like if you look at something like Bitcoin, we still have this. For something that you can't hold in your hand, it's $120,000 for what is a Bitcoin. It's a bunch of ones and zeros on a ledger that's tracked for millions of computers. But you can still use it as exchange and stuff, but it's still a very volatile thing. And it's not really that store of value. My dog, my parents are moving, so they're they're hanging out, so they could probably hear within earshot. But my dog doesn't like them. So specifically my dad. Anyways, so yeah. So like I said before, like Bitcoin, they want to be a store of value, but it's so volatile and it's not really pegged to anything that I think that like what Alex was saying is that the stable coins and things like that will actually add a lot of trust to the system. But as of right now, like there's no way I'm going to take half of my life savings, what's left of it, after holding shorts. I got one laugh. That's good. So like I think what's going to happen though is there's going to have to be some sort of like US dollar tracked sort of stable coin, something that's going to create this store of value that people can have trust in, that doesn't move 10% in a day or like a Saturday, something like that. I think that's really where a lot of that fear is. So until they solve that problem, I don't think it's going to be that store of value. So that's why I kind of think it's going to push more money towards commodities. So that's why I'm still kind of bullish with that. And also, we do get those fifth wave extensions with commodities that can be pretty nice, like those tailwinds. So that's kind of what I'm thinking here. Also, too, I did see an article yesterday that the banks are getting pretty scared of some of these coins, just because they're thinking that some of these exchanges can draw deposits away from the banks. So of course, follow the money, and the banks, they use your money to invest and create money for themselves and build branches and all sorts of things. It's a business. But once the deposits are taken away from them, so that they're fighting that tooth and nail. So if they do get their way, which they likely will, that until again that has been solved, I still feel like there's the crypto market and everything is just still speculative. They need to have some more regulation with like names and like who these people are. Like there's a lot of these pump and dump schemes, and anyway, so I don't want to drone on about it, but it just seems like an immature market, and I don't think a lot of people have trust in it. Like I don't think Grandma Gladys is gonna put her retirement savings into cryptocurrency just because they don't understand it. It's computer based. I understand gold. It's real easy. It's a bar heavy gold. But anyways, like I mean, I'm just I'm joking around with it, but like the reality is there's just a lot of immaturity there with the market. So that's why again I think like oil, gas, the standard sort of stores of value or typical inflation hedges are gonna materialize. Now gold is already pretty high anyways. Now if we kind of zoom out here, you can still see that there's even with contract rolls and everything adjusted, you can still see that there we had a really, really large a wave 3 here, and I think it was a couple of it's definitely last year. I think it was right around I started the service. I was calling for like this cup and handle sort of it ended up playing out. I think I got lucky on it, to be honest, but so like this kind of cup and handle thing is really like a bullish sort of pattern. Like you get this accumulation, but I mean, when you say accumulation, I mean, this is a long time to accumulate. That's not really realistic. But I think that, in combination with rates going down and then all of a sudden like rates not going up, like at that normal inverse correlation that you have kind of broke. And that's why people are, that's why people were really buying gold, especially, what was it? April. When was that? When did it get nuts? I think I had a whole bunch of dust shares that were left in the dust. Right around, I think it was like April of last year or something like that, where it looked like a wave 5 and then it was going to, kind of take a turn, but it didn't. But now that the market's matured, I shouldn't say that. I just said that about crypto, but now that the market's kind of like, spoken for inflation so far. Now I think what we're going to see is sort of an acceleration a little bit higher. I mean, if the S&P can reach 6,500, there's no reason why gold can't reach 4,000. I mean, it's just kind of, it's one of those things where like those commodity waves, those wave fives typically extend with that. And with equities, it's usually wave 3. And I don't think we've seen really the last of it yet, because we're seeing, like a pretty standard, like wave 4 sort of triangle. So that's just, my thought on it. Whether the counts are right or not, I still think that it'll get a tailwind, just because there's a lot of, people that are now, that would normally be bond buyers that are not bond buyers anymore, or maybe they're trying to, deploy capital elsewhere, different foreign currencies, something a little bit more stable, who knows? But one thing's for sure is that, the trust in like the dollar and interest rates and like the, independence of the Fed, like all that stuff is weighing on, on foreign investors who would typically buy bonds, and that's driving up rates. But higher rates in this situation, I think it's not going to correlate with its normal, or at least gold and silver, as we've seen. I don't think it's going to correlate with its normal relationship. So I don't want to drone on about it, but you guys can kind of get the point, right? Where it's like, silver's been ripping higher, and Don's gonna, he's got the gains cruise in mind, with all the silver profits. But we're doing a cruise next year. I'm doing it. If you guys are still my faithful loot pirates, we're doing it.
Well,
no more talk this time.
That's why all the shorts I have are going to be good for tax losses.
That's right.
Put against all the gains I have. So
that makes my heart hurt, does. You harvest tax losses by service. I'm sorry.
Well, I missed out on several good stocks.
Yeah, I agree. Yeah.
That I sold for because I needed the tax loss in December, and like AMD, I sold for a tax loss in December, and a couple others, and of course they ripped up this year.
Yeah, it's been frustrating, but a lot of the time I've spent, typically like I'll, once a month or something, I'll pull out all my books and kind of brush up on, wave theory and some of the, read your bullet points, right? Things you've gone and highlighted in your college textbooks, sort of things. And I'll just kind of brush up on, some things. And there's, on occasion I'll see one or two things that pop out like, oh yeah, like that. Now that does make sense. And just thinking about it in hindsight, when you're looking at like the anatomy of a bubble and kind of how, and you might find this interesting too, like with the VIX kind of staying crushed where it is. If you guys are aware, if you guys have read that now we have the Shiller PE ratio is now higher than it was in 1929, and it's really close to where it was in 1999. So so when it comes to bubbles and excess, like, I mean, you guys all know, you guys are smart, what kind of drove this. There was all that liquidity really, and prices follow liquidity, no matter wave counts, whatever. But the fact that the wave count's still held actually is another credence to or is another tip of the cap to this sort of methodology. But when you look at it all, even though here, sorry, I got like futures. I have silver pulled up here, but let me pull up something else, just as a quick level set here. So when we look at this from like a logarithmic sort of view, crap, I gotta pull up. Sorry, this is just like spreadsheeting live in front of your boss. So, all right, here we go. So if you look at the like what, it's from a logarithmic view here, you just look at the entire SPX, and it's nothing but up and to the right, and you see this big dip with this big dip with COVID and stuff. It was all bought up right away. That's all liquidity driven, and money supply, all that sort of fun stuff. But then when we start to look at we start to go back here, like in 2008, right? We can see that there's, a very clear 5-wave impulse here. And then, if I did have the data to go back farther and farther. I might. You see here. I should. I pay enough for the subscription to TradingView. Let me see if I have it. Nah, sorry, I don't. But I had another chart that was overlaid where you can kind of see like you had a whole bunch of this chop from like the 40s and 50s. Sorry if we go back. Yeah, I'm sorry, you can't really see it. Okay, I thought maybe we could. But long story short here is that, we really didn't start to accelerate until maybe like the late 80s, right? And then and everything just kind of went bananas. And then we had the dot-com, the dot-com bust here. Didn't really impact the S&P as much as like the Nasdaq, but if you take something like the S&P, I mean, it really just kind of made a double top, really, from a logarithmic scale, and then dropped again. So, this is like this is like a 1 decade long, corrective move. So then when you start to look at it off the bottom here, so if we have that corrective move, this could be like a wave 5. Maybe it might be easier to see the weekly level. Just saying, like in general, like maybe this could be some sort of huge wave 5 or a wave 4, or sorry, wave 3 or wave 5. And that's why I've been kind of thinking that we might see like a really nice correction, like a 40-50%er. That, I mean, nobody really see it coming, but from like a long-term perspective, you can still see that, like even the COVID low, like what does that do? That cuts the market in half, right? Well, sorry, now at 6,500 it doesn't, but I guess it kind of puts it back to where it should be, I guess, from like a PE valuation standpoint. I'd say like 3,400 is probably reasonable, but of course I'll get a lot of pushback on that. But just from like a math standpoint here, you really want those PEs in like the 18, 19, 20 range in order for that to be stable. Now it's at the 41, something like that. So it's it's really double. So if you kind of take that and factor that in, it's really just been concentrated to a couple of companies. So to kind of go back to, I guess the main point here is that, like, once we start to see like these super cycles, with excuse me, like with commodities, like gold, silver, things like that, you can really start to see like how kind of organized it is and symmetrical, once we're looking at it from like a really high level view. Another thing I wanted to show too was the yield. So the yield, we're kind of like in, I don't want to say uncharted territory, but if I pull it up to, if I pull it up to the weekly level, I mean, you can see that this has, pardon all the clutter, but this has just been one massive flag for the last 40 years, really. That's kind of crazy to me, because you're essentially like trying to stimulate the economy with lower and lower and lower rates, but nobody wants to take the rates back up. And then eventually you have this like liquidity crisis that's driving everything up. I shouldn't say it's a crisis. Okay. It's not a crisis, but you have this liquidity sort of avalanche, I guess you could say, from the 80s that really just juiced this whole market. And, eventually it's got to come back down, or it's got to correct itself. So I think from like a long-term perspective, when you analyze the anatomy of bubbles and stuff like that, you kind of get a sense of like, okay, well, where are we in the bubble? Is this the the blow off top stage? Is this the accumulation phase? I think we're well past the accumulation phase. If you pull up something like the Nasdaq here, I mean, the Nasdaq's gone up like 400% or something ridiculous. Even if you pull up the weeks, and if I pull it up, let me do NDX. Sorry, I'm screwing up all my charts. That's all right. I'll do it for your bed. It's all right.
Yeah,
I do appreciate you guys joining. I know it's been a tough couple of weeks here. It's tough to stay engaged when you just see accounts melting. Okay, so here we go. This is the logarithmic view here of the Nasdaq. So go all the way back to that dot-com bubble. I mean, you have, in my opinion, I mean, this to me is a very clear sort of sort of a 5-wave sort of thing. It doesn't mean it could end tomorrow. It means it could also extend higher. But what I'm saying here is that once you get to this sort of like fifth wave sort of thing, which is what we've been in for a couple of years, right? So like ever since we've had what was that, 2022 or 3 or whatever, we had the year of or a couple months where it was just nothing but like selling, started kind of in January. You see some of that distribution there, but excuse me, you also see this this increase of volume here as we start to get a little bit more nuts. So if you kind of zoom in here, so when the tariff thing happened, I mean, you can see that this volume has been elevated by at least 30% versus the average past or earlier than like January of 22. Now you can start to see that there was real panic there for a minute, and then I'm sure we got some wind that it's a good time to buy, right? So no crying in the casino, I've heard. So so I guess the whole moral of the story here. So Gaines, get to the point, right? The point is, we don't know when it's going to stop or pop or whatever, but what I can say is that this is, in my opinion, really, really close to like late stage bubble. Like we're in the mania phase where it's just nothing but up. Bears are ridiculed, made fun of. A real dip that should have cratered. It didn't. So, well, I mean, even though it did like what 20% over the course of a couple of days. If you guys remember your stock market history. And even though we've had a lot of time that has elapsed since then, like in what was it, 2008 or sorry, no, 1999. I think we had like a 12% down day or something like that, and then market rallied for 3 weeks after that, and then it had another 8 or 9% down day, and then it was toast. So we just had this one little panic event that everybody bought up, and we all kind of thought it was gonna bounce right here, and then it gapped up. And so like the bulls kind of had to resort to like trickery, right, to kind of keep the bull market going. And one of the things I've really learned this year is like watching price action and seeing like you can kind of see the mania like manifest itself with buying. And like for example, what they'll do is if you pull up like today, and there's a larger point here, guys, sorry, but if you pull it up today, oops, let me show this. There we go. If I pull up, so what I've been trying to read here and trying to understand more is like, where do you like where like how do you maintain the edge? Like how do you read it, and how do you make sure you can understand it? So when you look at this, like, okay, so you can clearly see that the bulls have been driving it up all day. And then right at the close, like the bears will sell it down because they don't want the bulls to spike it up and make higher highs and, so on and so forth. But that's really just like for the night. So what these guys do is they'll keep it within, 0.5% higher, or like 0.5% of the high. And then the bulls will just keep, they'll just keep buying it up. And without any major catalyst, there's just really no reason to sell it down. So I guess to kind of tie us all together, what I wanted to say here is that I do think that we're getting pretty close. Here we go, pretty close to this sort of bubble popping. Now, I think that everybody that does say that usually ends up with egg on their face here, but it depends on like some of the different counts. Like for example, right now we're seeing, again, like layoffs, we're seeing stagnant wage growth, but then we're also seeing higher prices for things. So we're heading into stagflation. It's going to continue to be a drag on the economy. It's going to be, like 6 months down the road here. I mean, look at the housing market. I can personally attest our house is priced right for the rest of the houses in the market. We've gotten 2 showings in the last like 2 months. So, right. It's like, I don't want to keep lowering the price because nobody else is, but you kind of know in the back of your mind that it's going to have to come down. So, my parents ended up getting very lucky, being able to sell their place. But they didn't have any showings for a month. Then they just had one, but it only takes one. Right. So just those little examples, like you're starting to kind of stitch it all together. Like you've got this macroeconomic backdrop where you have a lot of people saying, everything's great, but it's really not that great. And you can kind of see the little things that are popping up. Like I always like to use the Costco toilet paper price as a as a guiding light. I mean, it used to be $16.99 back in my neighborhood, back in like January, and then now it's like $22.99. So like the difference between that, I feel like that's some of the impact of tariffs and also inflation. Costco has a pretty clear accounting mandate. Like I think they don't do anything more than like a 14% markup or something like that on their goods and services. But I guess to kind of stitch it all together, there's just a lot of these things that are popping up that nobody's going to tell you, hey, you're in a recession, but it certainly feels like one. It certainly feels like it, at least with the job market. And I think that a lot of people are rattled with tariffs and whatever. And so I think that, this is one of these things that at the first the first headwind that you have is something big like tariffs, because, we're not going to know what the impact of all that is. But now we kind of know, those costs are going to be passed on to consumers, and eventually they are. So tomorrow we get the PCE report, and we're going to see likely an elevation, and it's going to kind of convolute, the Fed's capacity to lower or keep rates the same. From what I heard from Powell's speech at Jackson Hole was that unemployment is less of a factor versus inflation with their interest rate decisions. And I think that if Powell and the Fed are going to keep rates flat, I think that'll be the catalyst that'll finally kick equities over the edge. Because everybody's expecting a rate cut like it's just this foregone conclusion. But everybody kind of knows that, at least studies the data, knows that things are slowing down. I mean, you started to see balance sheets, even NVIDIA, yesterday, right? They only had like a 4% surprise or something like that. Those mega cap companies have like a 20% surprise to the upside. And if you look at some of their financials, you can kind of see that, it's kind of like it's crested, right? So what I've been looking for is not just earnings per share this sort of earnings season, but I've been looking at sort of like the revenue, right? And their baseline expenses. So even if their expenses go down and the revenue kind of, beats the upside, being a former FP&A, corporate finance guy, I can tell you that everybody has internal goals that are way higher than what they report to the street. Because you never want to miss when you report to the street. At least no good accounting VP is going to let you miss when your numbers hit the street. So usually your targets are really high and lofty. When I worked at a company that shall remain nameless, what they would do is and this was a couple years ago, they started with, let's say, 12% subscriber growth, and then at the end of the year, we were trying to figure out how to make it so it rounded up to 6 instead of 5. Instead of rounded down to 5. So it's hilarious because you're like, I mean, it's not illegal, but at the same time, you're like, well, I mean, if you got to find subscribers just to hit a number, so you beat expectations, then something is amiss. Either your forecasting is off, or the economy really is kind of slowing down. And usually, what those companies will do is they'll just reduce expenses in order to keep their earnings per share up. To say, look, we're making changes, we're shifting towards AI. You hear the same story, but you also hear the same story back from 1999. There's a lot of echoes. So there's a lot of things like that kind of generate these memories. So anyways, I'm not trying to be like a doomsday sayer, whatever thing. So I think that there's really 2 scenarios that I think we're going to run into here. So again, to kind of reinforce, if equities roll over, so if we do see something like this, like with the S&P or the Nasdaq, this could very well be like a wave 4, like a longer term wave 4, which would take us into, I mean, if you're thinking about symmetry, let's see if I can estimate it here for you. If this is like a wave 4, maybe it'll break, let's say like here. So at maybe like 6,600 or something like that. So if it breaks, and because that is a normal sort of pivot point for an irregular sort of pattern. And since we do have the mania phase, I think this is what people are thinking longer term, which could take us an entire year to really sell off. So it could be like a repeat of, like what started in January of 2022. But it would be a little bit more sustained and probably a little bit more powerful, which would probably take maybe 30 to 35%. So 32, something like that. And this would be a realistic sort of sea leg for this. But then what that would do is, and I don't want you, at least like I don't want people to be surprised. So if, like, this is a pretty key level, and even with April, we did break beyond it. So it kind of invalidates some wave patterns and things. That's also kind of why I think it's corrective, because we did. Oh, sorry, that's the S&P. The Nasdaq is the one that broke. Oh, look at all this crap here. I'm sorry. But you can kind of see this here. I think we talked about this last time. So from wave counting perspective, technically, this can't really be like a wave 4. But, that was also like a panic sort of thing too. So I have to try to consider that. But also, the S&P is really the most important one to follow with that. So with that being said, it can be an irregular, and we could get some sort of sea leg and make like a big megaphone pattern. But I think that if you go back here, oops. But if you kind of go back and look at this, even if it doesn't, it'll still set up something like it could be even crazier sort of wave 5 super bubble thing, right? Where we could go up to 7,000 or something for the S&P. And I think that's, to be honest, I think it's reasonable given the market conditions that we have and current leadership. That would be very favorable for midterm elections. Get the selling out of the way, in a non-election year, and then everything's fine, everything bottoms. Just from like a strategy perspective, like you could see something like this, and as much as I think a forecast this far ahead is probably ridiculous. Like you could still see that something like that could be possible. And if you kind of drag it back to like the weeks, and if I try to do like log scale again, you can see that it could be a nice like a nice wave 5 sort of thing. So I don't want to dwell on it, but when I'm thinking like short term here is that we're getting pretty close here to like the final sort of like mania high here for this bull cycle, and at least for like a year. Typically recessions last for like a year and a half. I think that the current administration is not going to settle for that. They're going to try to juice the economy even more. They're going to lower rates before it's ready. So I think that what that's going to do is stimulate more inflation. So who knows? So long story short, the entire thing is I kind of wanted to take you guys like through this, this odyssey, if you will, of like prior bubbles and some of the things that have been factoring into that, and then kind of look at a current situation where nobody knows where it's going to stop. And what is becoming pretty apparent is that with our excuse me guys, my throat is a little bothering me. But if you can kind of see this here, like this sort of ending diagonal, I kind of zoom out. I think that once this pattern completes, it's going to be, I think we will get a really, really nice pullback. So, Neil, I know with UVIX, it's been frustrating. I agree. Or some of the other guys that have been holding UVIX. What's happening right now is that the VIX is being stepped on with volatility, just with institutions like selling calls and market makers having to absorb that. There's just really not a lot of volatility that's driving anything. So I think if you guys remember, Neil, Dunn, I don't think you guys were in the service at that time, but Ben, you might remember I think it was like a 4-unit, like 40 grand UVIX or whatever trade that was, I think it was like 60% underwater or 70% or something like that.
I do, yeah.
Yeah. But I was able to get out of it at a profit. And that was just, I think with the, I want to say it was like the yen carry trade blow up right around here, something like that, like last April, something like that. But yeah, I'd been holding on to those for a couple months, and I was getting a little irritated. But the same thing goes here for, sorry, let me pull up another chart, a little cleaner. So when you look at this stuff, I'll just pull up the S&P. It's easy to get, frustrated and want to like, and want, I want to close it and I want to, start over, start fresh and start new. Well, I don't think anybody really expected this to, like this sort of, new high after new high. It's still not as crazy as like prior years, whatever, but this is now the third year where we have had more than a 20% gain in the market, which has never really happened. So going into the end of the year, I don't expect it to be kind to indexes. So if you're holding these shares and you're getting a little sweaty with your mouse, your mouse click finger, what I would encourage you guys to do is, if you have available capital, think about more hedges versus trying to harvest some losses, because going into the end of the year, if the market still hasn't fallen down, I think it would be very, very difficult to keep it high like this, because there's just not a lot of inventory. We had like 2 days of accumulation, I guess you could say, to just to buy, and they've been kind of unloading in here with all this volume throughout the last couple of weeks and months, really. And typically the summer is kind of boring for markets, but longer term patterns have a habit of performing well, and the ending diagonal is one of those patterns that I really like to trade, because it happens to be, especially the 4 and the 5th wave, happen to be very, very reliable. So again, if we measurements and things like that, like there's a ton of gamma here at the 6550 level for the S&P, and same thing with SPY. So I kind of think they might keep it pinned up here for a little bit longer, because there's some like iron condor trades. There's like 18,000 contracts or something like that on it. But I kind of think that we'll probably see. I think we'll kind of see like Labor Day here is like the turning point where we might have another run tomorrow, but I just think that with a little bit more patience, it shall be rewarded here. So that's kind of where I'll stop, like with the regular equities and commodities and stuff like that. Hopefully it was at least interesting, if not educational. But I guess what I'm trying to say overall is that we might have a little bit more upside to go. But I think that a lot of people are getting tired of it. I think like you go to X and you read a bunch of stuff like, oh, another update, whatever. You're like, well, okay, you can complain about it or you can try to trade it. But in my opinion, this has been probably one of the most dangerous rallies I've ever traded, just because of like it like one day it seems like it's just imminent collapse, and then nope, they buy it up, and then you just repeat that 30 times, and then also you're going into NVIDIA earnings yesterday, which is larger than their market cap is larger than the fourth largest economy in the world, right? So it's essentially like NVIDIA is reporting their own GDP for and there's no fear. There's no like VIX is at rock bottom lows, and that's where you get that like super divergence, which is super scary. At least scary for like 401ks and stuff where like you have longs that are longer term sort of trades. That's where I'm getting a little concerned, where it's like, well, do you close them? Do you hedge? Do you, because it could go up a little bit higher, or maybe you can just sit out. So those are the choices that, like people that don't trade markets don't really have to make, because they don't really care. They're like, oh, I'll just leave it in there. And they've been rewarded. Like I was, I think I said it before, like my wife's account, it was like a test case. It was like, like you just buy and hold and then forget it, and then see if it beat my account with trading. And no, she beat me. So, so it's like, you can leave it in, and just, average index, up. But, the people that try to trade it, like, I think your average return will multiply once you actually get some sort of volatility. So we've just been having these little bumps up, down, these little gyrations. It's really when you get those, 2-3% days up or down that really make your year. So I guess I'm really looking forward to this thing kind of rolling over here to get a little bit of volatility, because I don't want to buy anything up here. The second you buy up here, north of the 6,500, it's like, yeah, I just kind of use like market cap in the back of my mind as like it's too much, but doesn't mean it can't can't continue to go up. So all right. With that being said, what kind of questions do you guys have or comments, complaints?
Yeah, I've been just running some spreadsheets on how bad things look if it goes up 5% or 10% more or 15% more. Because again, I agree with you. I had trouble going into hedging TQQQ at this point. I just feel like it'll implode. Although maybe I should and let it happen. So I just wanted to get your read on how much are you feeling like 5% higher is possible before we make a turn? 10%?
I'd say like 2.5. I think it's a really good question, and I don't want to discount it just by kind of going off the cuff and saying like, oh, 2.5.
Yeah.
What I think is happening here is that we see this extension all the way up to this 1.382 that will qualify as like an irregular, and if we don't have any pullback before then, or at least like that's the theoretical B wave max here. So just using this as a guide. I mean, you could see something like this, and I think that would be more than reasonable to get a pull back to 4,500. And if I measure this, it's probably going to be another extension. Okay, so maybe like 4360, something like that. That might be a little far. You would probably expect some support around here. So yeah, okay, 4,600 maybe. But what I am thinking though is this is kind of like your bifurcation point. So the 66.53. If we don't have any sort of material pullback, I don't think there'll be any more buyers left, other than just speculators. And the VIX is already so low that once you get past a certain point, there's going to be people just buying protection to just buy it, because a lot of people around the country and the world and stuff are having the same conversation we're having today, which is looks a little high, right? So like, I don't want to buy it either. So you're starting to run out of buyers, and then there's no inventory, or not inventory, but there's no real like substance there. And market makers aren't making enough trading revenue, all that sort of stuff. Even though the options market is really dominating everything, it still has a lot of systemic risk. So I say that, probably less than 2.5%, just because that is like a extension for a very long term sort of fib level extension. And if you kind of look here, we've been kind of bouncing around this 1.236 for a while, and that's typically not the stopping point for like a B wave. But the next stop would be super ridiculous, where you had this extension all the way up to like the 1.68, which I don't think is realistic. I mean, I think, like, for example, we should have a larger wave pullback before then. So you should have like, here's your 7,000, and then let's say you do get, just to kind of model this out. Sorry, we'll use the point of control. So there's no reason why. So let's say it does go to 1.382. And this actually looks pretty good here, where you got this point of control here, like right at this theoretical wave 4 low. So you could see something like this, and then so that's your your wave 2, your wave 4, and then you kind of see like heading up there. That I think could be realistic, but without any real pullback there, I don't think that's a possibility. Like, for example, I don't think that you're going to see this. I think that's I mean, I could be wrong, but I'd be wrong. Yeah, but you see what I'm saying though? It's like, but like this is a very, very drastic move up, and the only way I think that this could probably happen here is, I mean, because you're talking about like trillions of dollars more of market cap. There's so many people that are now short that wouldn't participate in buying, that there's just not enough momentum to keep it sustained, which is why I think you might see something maybe a little bit more like that, and then some sort of ABC, which could then make this like an official wave 5, which could take us all the way up to the 7,000, which I think is a realistic scenario. At least this is probably probably the second most bullish scenario I can think of. But even taking a ride back to sub 6,000 here, I think would be not just healthy. It would be almost like engineered, where you would be able to get a lot more accumulation at those levels from additional buyers. So it's like, if you're a bull and you want to keep the party going, you can't just keep grinding it up like they've been doing here. I do think that this will probably peter out as or end up as like a wave 3, and then pull back for like a probably a more lazy sideways kind of 4 going into the end of the year, something like that. And then maybe it's a little too premature to say, probably like November, December, we'll get the Santa rally or whatever and kick off another rally higher. But if you do get this from this 66.50 all the way down to this 59.88 or whatever, I think that would certainly be enough to get out of the UVIX position and profit, because that's, what is that? It's got to be more than, or about 10%. Hey, how about that for freehand? Yeah, so 10%. So if you're looking at it like a 10% correction, is kind of weak sauce when it comes to how far we've gone, and that's just not including anything it's not including anything that you might have that's an external factor, like the Fed keeping rates flat, something like that. Like that would drop the market, I think, at least 10%. So hopefully I answered your question, Neil. I think at least for the S&P, it would be like that
answers it.
Okay, great.
Thank you.
Sure, no problem. And feel free to send me a DM or something too if you have additional questions, or if you want to share your sheet or whatever. Like, hey, I love a great spreadsheet. So
It's
really,
embarrassing.
guys, so really, guys, like I want to be here for you guys. And I want to make sure that like I'm trying to do the best job as possible, trying to read the tea leaves here. Obviously I can't control the markets and everything, but what I can do is I can at least try to revise the analysis, and just try to do a better job of if you guys need to increase frequency or whatever because you're getting nervous about higher highs or lower lows, some of that stuff, like just feel free to ask. Like I'm happy to do it. The last thing I want is you guys to lose money or have to carry trades for forever. And I just think that this is a very tricky market right now, and I want you guys to be successful, obviously. So just let me know if you have any questions, comments, or concerns. Hopefully we get some sort of pullback here, so a lot of us can remain solvent, but excuse me. But I think that a lot of other people excuse me, are in the same position. Excuse me. So I think a lot of people are in the same position where they've shorted too early. Like tariffs, people getting scared, that kind of thing. Now I think it's just a speculator's game, and it's speculator versus speculator. And I think that there's all these little funny tricks they play, like quashing the VIX so they can pick up options on the cheap. So when they actually do send it down, they'll make a boatload. It's just the way that they engineer the trades, in an option heavy market, I think is certainly worth a comment. But okay, that does it for the day. I do have to run here and go pick up my kids. But like I said, let me know if you guys have any questions. Happy to do another webinar or something like that. If I didn't, or if I covered something poorly, which happens.
Great.
All right,
Thank you.
Yeah, no problem.
Thanks, Gaines.
All right, see you guys. Good luck.